Good evening, ladies and gentlemen. My name's John Hardigan. I'm a member of the Young Professionals Board. I'm a vice president at BNP Securities, which is a subsidiary of Banque Nationale de Paris. And I'm also a member of this Mercantile Exchange. I'd like to welcome you this evening to our Young Professionals program on the U.S. financial market's role within the world's economy. I'll introduce our speaker, William J. Brodsky, President and CEO of the Mercantile Exchange, in just a few moments. The world's financial marketplace is a dynamic entity, having undergone a tremendous evolution and maturation process over the past decade. The U.S. markets, and in particular, the Chicago Mercantile Exchange, have solidified their position as the world's leader in risk management. While the view of the U.S. equity market has traditionally been in a nationalistic sense, the reality couldn't be farther from that. Here at the Merc, for example, the world's largest stock index, the Standard & Poor's 500 Index, brings investors from every corner of the globe into the U.S. stock market that, as recently as today, has continued to set records for growth. The Mercantile Exchange also offers a product line ranging from Japanese yen currencies to Eurodollar and Euro yen interest rate products to the Brady bond to the Mexican and Brazilian Brady bond contracts. Venues such as the Chicago Mercantile Exchange allows risk managers all over the globe to participate on an instantaneous basis in the world's economy. Speaking more specifically on these subjects, and particularly the stock equity markets, is our guest speaker, Bill Brodsky. Mr. Brodsky's been in the investment business for almost 30 years. He joined the Mercantile Exchange in 1982 as Executive Vice President and Chief Operating Officer. In 1985, he succeeded Clayton Yoder as President and Chief Executive Officer. Prior to joining the Chicago Mercantile Exchange, Mr. Brodsky was with the American Stock Exchange from 1974 to 1982. From 1968 to 1974, he was an attorney with the New York investment banking and securities brokerage firm of Modell, Rowland and Company. Mr. Brodsky is a former board member of the Chicago Council, is a current board member of the Chicago Council on Foreign Relations, J.L. Kellogg Graduate School of Management, and the Chicago Association of Commerce and Industry. His forte to the Mercantile Exchange and his concentration over his 30 years in investment banking has been primarily in stock indexed options. He's been a pioneer and a leader for this exchange in developing products such as the S&P 500, which is now a benchmark for what the world looks at as the U.S. stock market. Mr. Brodsky has been gracious enough to join us this evening. He will speak for a few moments and then open to you for questions. Partial way through the questions, I will step back in and let you know when it's time for tours. If you wish to step away and join a tour of the Mercantile Exchange, I will direct you at that time. If not, Mr. Brodsky has been very kind as to stay and answer all the questions that you may have. So at this time, I'd like to introduce William J. Brodsky.
Thank you, John, and welcome everybody. I'm delighted to see such a crowd here. I'm sorry we don't have seats for everybody. I hope that you're all able to hear. What I thought I would do with you all tonight is three things. One, I want to give you a little background about Chicago and how Chicago became the home and the center of the world for futures and options markets. I also want to talk about one area of our activities in particular, which John mentioned, which is the area of stock indexes. And then I want to talk about what I consider a very significant trend in finance, and that is the role of indexation in equity investing. And I imagine that at least some of you here have some money in the stock market. And with the Dow hitting, I believe, another new high today, I think it's probably a good time to talk about the stock market and how not only institutional investors are investing their money, but how many individual investors are investing their money as well. There are many, many areas we can discuss, and I just want to cover these areas for you and leave plenty of time for questions as I finish. First of all, to go way back, the Chicago futures markets, which were called for many years the commodity markets, started back in 1848 with the creation of the Chicago Board of Trade, and really were very important in creating Chicago as a financial or commercial center for the United States. And I don't know if many of you are aware of it, but the establishment of the Erie Canal was very much tied to the history of Chicago. And when the farmers used to bring their crops into Chicago from the Midwest, it became a problem of not being able to protect themselves from supply and demand, because everyone would bring their crops in September and October, and there'd be a glut of wheat and corn, etc., brought into Chicago. And what was developed in 1848 was the Chicago Board of Trade, was the creation of a futures market where farmers in April and May, when they were planting their crops, could sell into the future and lock in a price so that when they wanted to then deliver their produce, they had already locked it in back in May, and now had a price on which they could guarantee themselves they could sell their production in the fall. So we didn't have these tremendous swings of supply and demand. That is a very important aspect of futures markets, and that is the ability to hedge. And so farmers back then and continue today to be able to hedge by selling forward or selling into the future and locking in a price. The other important development in terms of futures markets is what we call price discovery. The price for various agricultural commodities is actually set here in Chicago, whether it's corn or wheat or soybeans on the Board of Trade, or corn and hogs at the Merck. If you want to know the value of these commodities 3 months, 6 months, 9 months out, this is the marketplace that sets the price. It becomes very important for people who not only grow the produce or the livestock, but those who use them or consume them. McDonald's for hamburgers or General Mills for wheat. So it's a very important part of the commercial fabric, not only of the country, but the world. But one of the most important developments was building on this tradition of futures markets was in 1972, and some of you probably can remember or at least have heard about Bretton Woods. After World War II, there was an agreement to fix currencies to the U.S. dollar based on the price of gold, and it was not until 1972 that President Nixon closed the gold window. We would no longer pay dollars for gold, and therefore currencies were floating freely. Well, the Merck felt that one way to capitalize on that and provide a place for individual investors to not only hedge their foreign currency risk, but also to be able to speculate in foreign currencies, was to create a new market based on agricultural futures, and that was to create the International Monetary Market, which is part of the Merck today. And that was the same concept, and that was that if you were for example, an automobile dealer buying Mercedes-Benz from Germany, and you agreed to purchase them 6 months from now, and you agreed on a price, but you had to pay in Deutschmarks, what would happen if the value of the Deutschmark went up dramatically from the time of the contract to the time of delivery? And so you could end up losing money because of the currency fluctuation, even though you sold all the cars. So this concept that was around for over 100 years in agriculture was now applied to financial instruments as well. And the growth became dramatic because we went from agricultural products to currency products, in the mid-'70s to interest rate products, and ultimately in 1982 to stock index products, which gave people a way to hedge in the broad stock market. And at about the same time as the Merck created the concept of currency futures, the Chicago Board Options Exchange was given birth by the Board of Trade, and there you had options on individual stocks. And in the same way that the farmer could hedge in terms of the production of agricultural products, a person who owns stock could actually hedge for the first time in a very logical fashion. And what the CBOE did is it took the concepts of futures markets and transferred them to the securities industry. For example, next-day settlement, where in the securities industry at that time and until recently it was a 5-day settlement, a daily mark-to-market. For those who understand that concept, that was a very important way of keeping the risk out of the system. And also certificateless trading. In those days on Wall Street, and I was there, you had runners delivering physical certificates. But certificateless trading, due to automation, made it a very, very smooth system. Throughout all this time, we always had a specific commodity that we were delivering, be it the agricultural products or whether it was treasury bills or Deutschmarks. We were always delivering something. But in the early 80s, we changed that as well, and we created cash settlement. And that allowed us to trade a variety of instruments that previously you couldn't do. Because if you had an index, as we do, of 500 stocks, it would be very cumbersome to deliver the 500 stocks. But once we had cash settlement, we didn't have to deliver physical stocks. We merely fixed it to the value of an index. And I submit to you that when stock index futures and options were developed here in Chicago and developed where the market and the CBOE now trade 90% of the stock index futures and options in the United States, we revolutionized the way Wall Street and the whole area of finance works. And not only did we do it for this country, but the model set here in Chicago has been so successful that we now have instruments trading on 34 exchanges, 55 or more stock index products on 34 exchanges around the world in 24 countries. So we all should be very proud that we helped do something that has now become a very important part of the equity markets all over the world. Let me give you an example of how integral we are to the stock market in New York. Because everyone knows in the United States the stock exchange is in New York, you have the counter stock markets in New York. Where do we fit in? We fit in because the big institutions that are represent the large amount of volume in New York in the stock market deal through not only specialists on the stock exchange, but through the large brokerage firms. And when they want to buy or sell large amounts of stock, they need very often a large firm on the other side to help facilitate that transaction. Well, I've always said that it's one market. And when the stock crash occurred and Secretary Brady and his task force studied the markets and they realized it wasn't Chicago and New York, it was a linked market. They were together. Well, it took a few years after that. Everybody remember the flood in Chicago? We have this unique river that leaked. Well, when the river leaked, we had to close the building for the day, not because we were having water in the building, but because a lot of the offices in the area which were being flooded, and because of concerns about fire and electricity and water getting into the buildings, the fire department asked us to shut down. Well, on that day in April of 1992, we closed down and the CBOE closed down, and lo and behold, what happened? The large firms who normally make markets for the institutions in New York and other places, but particularly in New York, said, wait a minute, the Merck's closed, we can't hedge in S&P futures. The CBOE's closed, we can't hedge in S&P options. We're not making markets. And it was the second slowest trading day of the year on the New York Stock Exchange. So if anyone doubts how these markets interact, that's another way to look at it. Now, you've heard of triple witching hour? Triple witching hour is what I would call a contract expiration date when futures and options all expire at the same time. It happens every month, but it particularly happens once a quarter. Well, on an average day, the New York Stock Exchange does about 300 to 400 million shares. On those expirations, the volume explodes to 600 million shares because the professionals who have these positions and who are using the market all the time now are what we call unwinding the positions. And we've done a lot over the last few years to ease the impact on the market because of the volume that's created on those specific days. Now, that leads me to what I will call a major trend in investing, not only in the U.S., but around the world. Many of you own mutual funds. How many own mutual funds? At least 50%. How many of you own index funds? Let me tell you a little bit. You don't, not how many? Two hands? Okay. Let me tell you a little bit about indexation. For those of you who have MBAs in finance or who've studied portfolio theory, may have heard of the concept of indexation. A lot of this started in the early 70s by a fellow by the name of Bert Malkiel, who's a friend of mine and a professor of finance at Princeton University, and others who studied portfolio management. And people have looked over the years as to whether anyone can pick a group of stocks that can consistently outperform a broad market index. What's a broad market index? Is the Dow a broad market index? No, it's 30 stocks, it's price weighted, everyone's heard of the Dow. But if you are a fiduciary, whether you're running a university pension fund or other large endowments, you have to have a way of judging how you're doing. And those of us who are in those capacities, and I am on 2 investment funds that manage a substantial amount of money, we will hire investment managers, and once a quarter or so, we will say, how are they doing? Well, we use benchmarks such as the S&P 500. That's an index of 500 stocks. It's what's called capitalization weighted, so that if IBM has more stock outstanding than a smaller company, then those shares are going to be weighted more than the smaller company shares. In large stocks in the U.S., the S&P 500 is the preeminent benchmark. And so, again, if you have an institutional portfolio, whether you're a pension fund, endowment fund, or otherwise, the managers of those funds are normally going to be measured against certain indexes. If it's a large cap index, it's going to be the S&P 500. If it's a small cap, it may be the Russell. But the point is that people measure against those. Well, most of us in those investment portfolios will try to hire managers who will do as well or better than the index. But very often what we're finding out is that it's very hard to beat the index. In fact, the S&P 500 index, for the 10 years ended in 1994, produced a return of 14% annualized. That's very, very good. The typical U.S. equity fund produced a return of 12.2%. Now, what if I said to you, I can give you an investment vehicle where you can get that 14%, and I'm going to give you 2 other kickers. You're going to pay less in terms of management fees, and you're going to pay less for taxes. Would you be interested in that? And yet very few people understand how indexation works and how accessible and efficient it is from a cost point of view to the average investor. Well, for many years, institutions have been doing that. Very large equity funds have been doing that because their funds are so large, whether it's a General Motors pension fund or the College Retirement Equity Fund, which are 2 of the largest equity funds in the United States. They learned many years ago that when they have $50 billion to invest, it's very hard to just pick stocks. And that if you just pick stocks or even just pick managers, that as you aggregate the returns, whether those returns will be better than the benchmark, the S&P 500. So many of them have said, we're going to take 3/4 of our funds allocated to large cap domestic equities and put that into the S&P 500. Well, the fees to do that, because you are not trading, you're only buying the stocks in the index in the proportion that the index has them, means that you're not turning over the portfolio, so you're not paying a lot of commissions. Now, many of these funds, of course, don't pay taxes, so the tax aspect for the pension funds is not an issue, but it certainly is an issue for individuals like us. Because if I take 2 funds that are exactly the same, one is an index fund and the other isn't. Now, the other fund is going to constantly be trying to buy stocks and sell stocks to pick stocks that are going to outperform the index. But every time you sell a stock for a profit, what happens to us at the end of the year? We get a little slip that says you have to pay capital gains tax on X, Y, and Z. The index fund, once they buy IBM or GE or Gillette or Coke, they never sell it. Because as long as the stock is in the fund, they don't have to sell it. So all the gains that accrue to those positions are unrealized, as long as you hold the fund, as long as they don't sell the stock. So there are a couple of factors that make it a very, very efficient way to invest your money. And I would say to you that 90% of the equity funds in the United States who are what I would say comparable to the S&P 500, large cap equity funds, do not over time outperform the S&P 500 if you take into account the tax aspects of it. Now, what does this have to do with what we do here? I could spend time tonight talking about our Eurodollar futures contract, which is the most active futures contract in the world. I can talk about our currency contracts. I can talk about our agriculture contracts. But the reason I picked the stock index contracts is that most of you will have equity portfolios, and I think you can relate better to it. Indexation has become a very, very important trend in investing, not only in the U.S., but outside the U.S., because it gives managers and individuals a way of getting access to a particular market, whether it's a segment of the U.S. market or a particular country. If I want to have an access to the Hong Kong market, the Japanese market, the UK market, the German market, sometimes it's very cumbersome to go to a foreign country and buy the stocks and hold them. because there are custody problems. The commissions are very high. Most countries don't have negotiated commissions the way we do. But what some sophisticated investors do is they buy stock index futures or options as a substitute for buying the index. And it's not necessarily done in a speculative way. It can be done in a very, very conservative way as what I call a cash substitute. And just to give you an example how mutual funds that you and I can own use futures and options, I just want to refer you to the Vanguard Index Trust, which is the largest index fund that's available to all of us. And they have the authority to use our markets and do. Because if you're managing an index fund, whether, again, for individuals or institutions, your obligation is to stay fully invested. You're not asking that manager to play the market. You're not saying, gee, the Dow is almost 6,400. You think you ought to lighten up on your stocks? If it's an index fund, you must be 100% invested in the index, or why be in the index? You might as well be in a money fund. But there are times when the index fund managers say, you know, we need to have some cash available for redemptions. So how do they handle that? Well, they might put 99% of the money of ours into the actual stocks. And then they'll take 1% of the money. They'll buy stock index futures equivalent to the 1%. They don't have to put up 100% of the cash. They'll take the cash and invest it in treasury bills or repos, so they'll have a cash available on a next-day basis. And that's how these markets are used. So if you look at the prospectus of the Vanguard Fund, it says specifically futures, contracts, and options may be used for several reasons. To simulate full investment. That's what I was talking about. In the underlying index, while retaining a cash balance for the fund for management purposes. And then it says, but this may not be used, while each of these securities can be used as leverage, etc., the portfolios may not use them to leverage the net assets. In other words, they may not do this for speculation. They're only using it as a hedge, the same way that the farmers would be able to hedge in agricultural products. They're using this as a way of hedging their stock market exposure by keeping some of the money in cash and having the rest in a futures or options contract. So we are very much part not only of the mainstream of the equity markets, but we're very much part of this tremendous trend toward indexation. And to show you how current this is, here's today's Wall Street Journal. It says small investors will look back on 96 as a year they finally got a break. I hope that you all got a break today with your investments. But it says here, as a fan of indexing, I've always wanted an easy way to build a global index portfolio. So this is today's Wall Street Journal. And he describes how you can not only index your investments in domestic stocks, but how you can index in global stocks. And the same concept applies. You're not trading stocks in and out, and you're not selling stocks and paying capital gains. The index holds the stocks virtually indefinitely as long as the stocks are in the index. And just to explain, so you can see on a daily basis how your index is doing, all you have to look is, again, at the Wall Street Journal, it says Stock Market Data Bank. Now, if you were in the S&P 500 stock index fund for this year, how well do you think you would have done as of yesterday? Anyone have any idea? S&P 500. How much? Oh, you're a dreamer. How about 23.48%? That's what the S&P was up this year as of yesterday, less management fees, which generally are 0.2% of the value of the portfolio versus maybe 1% of your normal mutual fund. The reason I tell you this is one of the great areas of the U.S. market where individuals really are at an equal level with institutions. Whether you have $100 million or $1,000, or maybe a little more than $1,000 to open the account, you have basically the same ability to benefit from this, what I would call very conservative and what's called passive investment strategy, as the biggest institutions in the world. So that gives you a little bit of a tie-in to what we do here and how this ties into what's really going on for many, many investors all over the world. I think I ought to wrap up because I like to take time for your questions, but I would just close by saying that one of my favorite stories of the many visitors we've had here at the Merck is that several years ago I had a fellow come in from London who was at a very senior position in the financial community there, and I told him how pleased I was that he had come to spend some time and visit with us. And he looked at me and says, "You don't understand, do you?" I said, "What do you mean?" He said, "If I want to learn about futures and options, I have to come to the Mecca of futures and options, which is in Chicago. So you should all share in the pride that we all have of what has occurred here over the last 25 years, and that is that we have become the center of the world for learning and trading about futures and options markets. So I thank you for your attention. I look forward to your questions. Thank you very much.
Before Mr. Brodsky takes questions, I'd like to just make one quick announcement, well, actually two quick announcements. First of all, for any of you who'd like to get questions answered about the exchange, specific questions about anything you see out here, there will be two representatives, one over here at the far end and one down there. There'll be Merck visitors representatives. I feel like a stewardess. One at each end. You'll see them. They have brown badges on. Second thing, want to first of all thank you for joining us tonight. I'm going to let Mr. Brodsky end up closing the program with his question and answer session, but I'd like to thank you for joining us tonight. We've got a great turnout. These events have been terrific. The next one actually is the British Holiday Cocktail Party at Pimlico Road. It's December 5th from 6 to 8. So if you don't have your tickets, please call and get them. It'll be as good as this. Probably not better because this is a pretty good one, but we'll be. We'd love to have you. So, Mr. Brodsky, can answer.
Thank you, John. Let me see where the questions are. Tasha has a microphone. Yes, Brian. Hello.
What are the major competitors to the Merck?
What are the major competitors to the Merck? There are two areas of competition, really. One is the international competition. We are operating under a regulatory scheme in the United States, whether it's securities or futures markets, that unfortunately is very much outdated. And so you have markets in London and Paris and Sydney and Frankfurt and Singapore and Hong Kong and Tokyo that are futures markets like this that weren't here 20 years ago but are now competing with us. And they have what I would call a much more friendly but not inadequate regulatory environment, because these markets have become very global. And we are working with the regulators in Washington to try to recognize that the rules that were set 20, 25 years ago are very out of date for the kinds of markets we have today. The other area is what I'll call the over-the-counter markets. The major brokerage firms can create products in their offices and offer them to institutions with basically no regulation at all. And we're all dealing with the same kinds of customers. Our main customers here, particularly in the stock index area, are the pension funds, endowment funds, and other large, very sophisticated pools of capital. They don't need the kinds of rules that were designed years ago. So they have to go through a lot of hurdles here, and they don't have to when they deal in the over-the-counter market. And we think there ought to be much more of a level playing field. Yes?
Can you give us your wish list then for deregulation?
Well, I think that there are many areas. One is in the area of taxation. There are rules on the books that absolutely make no sense. And unfortunately, even though we get a lot of support in Congress to change the rules, you can't get narrow little provisions in the tax law changed. It has to be part of what they call an omnibus tax bill. And there hasn't been a tax bill in several years. And so when there is a tax bill, hopefully we'll be able to do that. That affects institutions more than individuals, but the institutions are very often mutual funds that affect you. I mean, if a mutual fund wants to hedge using stock options or stock index futures or stock index options, there's a limit to how much they can use to hedge, which is absurd because the hedging function is an insurance function. I mean, what we provide to these kinds of institutions is the same as when you buy insurance on your house. You pay the premium, you hope the house doesn't burn down. Well, that's the same thing that we have here, and yet there are tax rules that limit the amount of insurance that these institutions can buy. Well, the taxation of insurance is a totally different issue, but my point is that a lot of these instruments have now been around 20 or 25 years, and we're still laboring under tax rules that probably never made any sense, but certainly make no sense now. Other areas are the regulatory scheme, which doesn't recognize that these markets have become incredibly institutional in their nature. And when you make an institution that has $50 billion of assets under management, sign 50 pages of forms to open an account, it's kind of absurd. And there's a lot of progress that we hope can be made. Our regulatory agency today, in fact, came out with a proposal that would streamline our ability to open new contracts. For example, we hope to trade a Taiwanese stock index soon. We want to be able to streamline that process because a foreign exchange could basically decide to do it and a week later start trading it. We have to sometimes wait 6 months or a year. It's called red tape.
Bill, what kind of future do you see for trading floors? You see many exchanges moving away from trading floors.
That's a good question from Jeff, who works at an exchange. The important thing for you to know is that exchanges with trading floors, whether it's in this country or abroad, whether it's the New York Stock Exchange, the Merck, the CBOE, Board of Trade, London Futures Exchange, the Paris Futures Exchange, provide a very, very important added value, and that's called liquidity. Now, it might not affect people like you and me when we want to buy 500 shares or 200 shares or 100 shares, but the institutions come in, they want to buy 1,000 shares or 100,000 shares or 100 contracts. Liquidity, the amount that you can buy or sell without moving the market, is very important. These markets, the exchange floors, have provided a very good source of liquidity for large investors. And so our view is that this is still the best way to provide that liquidity, but our job as exchange administrators is to provide as much automation as possible so that there'll be a time in the not-too-distant future when you'll come to the floor during the trading day and you'll see people trading, but you won't see a lot of paper. We're going to do a lot with handheld computers, you know, when you go check your car out at one of the car rental agencies and you get out of the car and they go, boom, 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 here's your receipt. But we want to do more and more of those types of things, and we're in fact testing something that we've never done before, and we're the first futures exchange to do that, and that is a firm with a computer terminal that's part of our system that can be in Europe or Asia, can actually key in an order during our trading day and have the order appear on a screen right in the middle of the pit. And the broker looks at it, says buy 10, and he does buy 10 in the crowd, presses that he bought the 10, and it goes back automatically by automation, no paper. Those are the kinds of things that we're doing that will preserve the good things of the trading floor and minimize the cost and keep these markets very efficient. Yes, ma'am.
What I found interesting, one of the things I found interesting about your presentation is that you emphasize the risk reduction aspect of using the options and futures exchange, and I think to the ordinary investor who you've emphasized can invest through these index funds. What is preeminent in their perception of the Merck is the high risk, and I was wondering how, for these ordinary individual investors, you would reconcile that perception to what you've related to us today as the risk reduction aspect.
Everybody hear the question? It's a very good question. I didn't spend any time on the speculative aspects of our business because I think that part of my job is to educate, and you don't have to educate people as to the speculative aspects because people who want to speculate always find us. But you cannot operate a market like this without people who want to hedge. These markets would not have survived over 100 years without people who have bona fide commercial needs to hedge, whether it's the farmer or the Mercedes dealer or the General Motors pension fund. If there's not a hedger, then everyone would be speculators and there wouldn't be a market. And our jobs at both the individual level, at the press level, at the governmental level, is to explain how we provide a very important risk reduction function. And these markets do that in a magnificent way, because if I explain to you how efficient these markets are, if you want to buy the equivalent of $1 million of stock through our stock index futures, non-speculative kind of purchase, versus buying $1 million of the same stocks on the New York Stock Exchange, our costs are about 10% of theirs. Now, that doesn't mean you should never buy stocks, you should only buy futures, because you do have to roll the position over every quarter or whatever. But the point is that for the large institutions who know, for example, that on January 1st they're going to get $10 million in, and they don't know which stocks they want to buy, they come in and buy the $10 million of stock futures at the Merck, again, in a non-speculative way, and then over the course of the next couple of weeks, they pick out which stocks they want to buy, and then they sell the futures contracts. And that's a lot of what they do. I'm on one investment fund that picks managers, and they hopefully pick managers that will regularly outperform the index, whatever that index happens to be. But we only meet once a quarter. So what happens if during the course of the quarter there's $5 million sitting there? If our asset allocation model says we should be 60% invested in stocks, but some benefactor gives money, and now we're sitting with the money. What do we do with it? Well, historically, we would put it into a money fund or into T-bills because we hadn't made a decision on which manager should manage that money in equities. So I said to them, wait a second, you want to be in equities? Our guideline says we should be 60% in equities, and yet you have $5 or $10 million just sitting around waiting for us to have a meeting. They agreed. I said, well, why don't you just invest the money in the index as a holding account until you've decided which manager to give it to? And we now do that, and I'm glad we do. Because if you look at what's happened in the last month, if that money was sitting in T-bills versus what's happened here, you would have lost a lot of opportunity where you would have been in equities anyway. So you can't say, well, what if the market went down? That wasn't the point. Administratively, we hadn't had the meeting to allocate it to a manager, but we would have if we could have. So there are a lot of ways that you can use indexation, either just purely by buying the stocks as the part of the index, or through these substitutes, which are being used as a substitute, not in a risk-acquired fashion, but as a either risk reduction or just to be equivalent, what I call a cash substitute. It's the same as owning the stocks, and you're doing it either on a long-term or an interim basis. Yes, in the back there?
Yeah, what are the pros and cons of a possible merger between the Merck and the Board of Trade? And how likely is it that that will happen in the future?
The pros and cons, I guess I could make a list of both. I think the most important thing is that you have two very large institutions that, unlike what you would call normal stock corporations, where the board of directors can decide to do something and basically make the decision and see it happen, you have here individual members who make their livelihood because of their membership. So it's not as if we own stock and you get some pile of paper in the mail and say, please vote for or against the merger. The people here have their livelihoods tied to their equity interest in the institution, which are their seats. And the view that we have is that there's a lot we can do to do things together to make ourselves more cost efficient. And we're studying right now whether we can combine our computer operations, for example, and do other things that will make doing business here even more cost efficient. But the concept of a merger isn't really what I'd say a front burner issue. And if it were to occur, it would be very complicated. We have 3 types of memberships here, for example. And even there, if we would try to consolidate the memberships, you have some very contentious issues because they're very economic to the individuals involved. It's not like a normal stockholder that says, well, I can just sell that stock and that's the end of it. You're tying the memberships and the interest in the institution to a person's individual way of making a living. Yes, ma'am?
Are you considering a senior position at the CBOE?
That wasn't really part of the outline of my talk. But I would only say that I am very happy that I've had some people coming to me about a lot of different things. I've been at the Merck a long time. I've been very happy at the Merck. And very often these things come about, and I'll take a look at them, but I have nothing further to say at this point. Thank you. Anyone have an easy question?
A question, you were talking about liquidity earlier. As fewer and fewer players manage larger and larger sums of money, net liquidity may be going up, but what are you seeing in the volatility rates?
Actually, it's a great question. It is amazing how the markets have had lower volatility historically than they had, for example, in the 1970s when the volume was much lower. The fact that the market is at a high level doesn't mean it's volatile. But when volatility occurs, and it can occur because of an external factor, interest rates go up sharply, there's a political disturbance or some military action, I've never seen a market volatile for a day. It's almost like dropping a rubber ball from here, and you'll get a big bounce, and then you'll get little bounces. And if you look at the charts, you'll see that volatility doesn't come in one-day spikes. But if you look at historical volatility, we're at a very, very low point. And part of the reason is that people have ways to hedge themselves in the markets that they never did before. And I also think, and I didn't talk about it much, but we've done so much in the equity markets in the last 8 or 9 years since the crash of '87 through circuit breakers and other intermarket activities that people know, for example, that unless we change the rules dramatically, the stock market can't go down 500 points in a day the way it did in October of 1987, because we have what we call shock absorbers and circuit breakers that limit that. Now, that doesn't stop the market from going down, but it stops it from going down, boom, like that. Yes. 1 second, we'll bring you the mic.
How do you rate the group's efforts towards promoting 24-hour trading? And along with that, how has the interbank market affected the IMM's market share?
Okay, we have two very different questions. One is 24-hour trading. If I had had more time in my talk, I would have talked about 24-hour trading and the fact that right now you can buy or sell S&P futures on an electronic system that we call Globex. Right now, you can do that. And you'll find that people, again, normally sophisticated individuals or institutions, will do that if there's a world event that causes them to want to do something before the normal trading hours. So you will see more and more of that, but what we have learned is that these markets are not going to be that active in the off hours. That the active hours for U.S. stock index products are going to be during normal business hours in the U.S. And that, I think, is something that we've learned through this experiment that we've had for the last several years on after-hours electronic trading. As far as the question about the IMM and currency futures and options, which, as I said, was the first time that there really were financial futures, we've seen not only has volatility gone down in currency, so our volume has dropped, but a large part of our business came through the banks. And there have been a tremendous amount of bank mergers in the last few years. I mean, when Chemical and Chase merge, or two big Japanese banks merge, very often what they're doing is they're reducing personnel. So you have fewer traders at these institutions, and if there's low volatility, we have like a double effect. You have fewer people who act as traders, and when there's low volatility, you don't see much trading. So I think that that's more cyclical than anything else, but clearly there's been a tremendous consolidation of currency traders through the consolidation of banks, and that's going to reduce the amount of business. And lastly, you'll see that there are fewer individual investors trading in currency products on the exchange because as they've gotten bigger, very often they'll go to the interbank market. And the currency area is the only area where we really have what I would say tremendous competition or tremendous market away from ours that people have an alternative. And we're doing things in currencies, for example, what we call large all or none, where you can put in a large order and you got an execution of all of it or none of it, which we never had before, and that was a way of trying to attract back large orders to the exchange.
What do you consider aggregate international equivalents to the S&P 500?
The other major benchmark stock index products in the world are the Nikkei index that trades both in Japan and in Singapore, the DAX index, which is the German stock market, the FTSE index in London, FTSE, Financial Times Stock Exchange Index, better known as FTSE, or the CAC 40, which is the CAC index in Paris. So those are the kinds of benchmarks. Hang Seng in Hong Kong, and you'll see more and more. This year, Portugal started a stock index product. Korea started a stock index contract. In Brazil, the Bovespa index is very active. So there are institutions that not only will buy stocks in these regions, but the stock indexes themselves become the benchmark, and very often they'll use the stock index futures or options as a way of accessing that market. Well, there are international stock indexes, but no one has traded a futures contract on them. The most commonly known is the EAFE index, which is Europe, Asia, and Europe, Australia, and the Far East. But that is very heavily weighted in Japan, and it doesn't include any of the emerging markets. So EAFE, while it's been a good benchmark for many, many years, does not include some of the major countries, and again, is viewed by some as overweighting Japan. So I don't see the same amount of people using EAFE as a way of getting into international markets as they might have in the past, but you'll see people doing what I call slices. They'll do countries or they'll do regions. But if you're an international investor, you very often, or if you're a U.S. investor investing internationally, you'll still use EAFE as a benchmark to see how your manager is doing.
What do you think the effect of the EMU will be on the mercantile exchange and on financial trading?
That is a very good question, and a very current question. For those of you who don't know, the EMU is the European Monetary Union, and by 1999, the major Western European countries, with the possible exception of the UK, at least initially, and with the definite exception of Switzerland, will consolidate. So you won't have a French franc, you won't have a British pound, you won't have a Deutschmark, you'll have a euro currency. That would affect us in that we trade the Deutschmark, we trade the British pound. You could see instead of them, you would have a euro currency. But we're also actively pursuing, on a very current basis, trading the interest rate on the euro, which today is called the euro mark. We trade the euro dollar, which is the U.S. deposit, U.S. dollars on deposit in London, a 90-day certificate of deposit. We trade the euro yen, which is the yen on deposit in London, again on a 90-day CD rate. And we will soon be trading a euro-euro as a way of having the whole complement of euro currencies. That's the short term. There's also a long-term side of that. So that's going to be a very interesting thing, and it's going to have a dramatic effect on the futures exchanges in Europe because each one was trading their own local products. Well, all of a sudden, France is no longer going to have a French franc contract or a PIBOR, which is their Paris interbank offered rate. It's going to be a euro rate. So it could have very dramatic and possibly negative effects on many of the successful exchanges on the European continent. Yes, ma'am. Right, we'll bring you the mic.
How do you expect the Hong Kong change in the next year to affect the markets over there?
I was in China this summer, and I can't tell you how exciting it is to see the futures markets in China. You know, you have to pinch yourself. You're in a communist country, and they have these burgeoning futures markets and stock markets. I mean, the Shanghai stock market is just booming. But I look at Hong Kong and the turnover next summer as very pivotal to the future financial success of all of China. And I believe that the Hong Kong Futures Exchange in particular will probably dominate the financial instruments, futures and options, for China. I think that you'll see a lot of futures exchanges in China which are really more commodity exchanges, and they are very important as a price discovery vehicle, whether it's steel or wood or other things. China is still very inefficient in many of its commercial areas. So the futures exchanges are really performing a price-setting mechanism, much the way that ours did a long time ago. But I believe that the Hong Kong exchange will be the financial futures market for China because of the infrastructure, because of the banks, and because of the fact that they're there and very successful. So I think you'll see a combination of things. But I believe that the mainland government, and I speak with pretty good authority, will support and nurture Hong Kong as that financial center. You'll see some challenges from Shanghai, though. One more.
Yeah, what are the advantages of the open outcry system over the market maker specialist system? Do you have any thoughts on that?
Sure. I worked for an exchange in New York that had a specialist system, and now I'm here at the Merck with an open outcry system. I would say that both have been extremely successful. I mean, there are no capital markets in the world that have been as successful as those in the U.S., and very much because of our entrepreneurial spirit. I mean, where people can literally come here and rent a seat for a very nominal amount and go out on the floor, and boy, is it a leveler. It doesn't matter whether you have a PhD or barely a high school diploma. You get on that floor, you're all equal. And that's the nice thing about it. But I would not say that one is better than the other. I think that in certain areas, the special system in low-volume stocks is very, very good. And in very high-volume instruments like the Eurodollar, the S&Ps, the open outcry market maker type of system is incredible. But you got to remember that a lot of this happened because of historical accident. The special system developed on the East Coast primarily at a time where there was no communications, and it just happened that way, and it developed and evolved out of that. And in Chicago, the special system, no one knew about what was going on the East Coast at the time, and people were trading in a pit in an open outcry fashion. So, you know, people have always tried to get me to take sides on these things, and I think you have to look at the history and the success of both systems and marvel at how this country has still and continues to be the leader in the world in financial markets. I think we're done, John. Are we done? One more? Okay, last
Yeah.
one.
Internationally, what are the emerging markets we should pay attention to for investments?
Well, I would say that I'm not as much of an authority as Jimmy Rogers, who wrote a book called Investment Biker, which I recommend to you. But he and his girlfriend traveled all over the world on motorcycles, and he then wrote a book about it. But there are obviously certain countries that people feel are going to be much more important than others. I really would refer you to the book because people have different opinions. And some people think Russia is a great opportunity, others think it's a disaster. Same with India. China is very exciting, but you have problems with regulation. But clearly, there are areas in the world, whether it's Latin America, Eastern Europe, where there are tremendous opportunities with tremendous risks. Western Europe, I think, is a totally different situation because they're lumbering under a tremendous amount of unemployment and fixed costs in their labor markets and other things. So you have to really look at different things. Or you can do something else, and you can buy an index fund on emerging markets and hedge your bets. Thank you very much.
Once again, we'd like to thank Mr. Brodsky. Also, again, on both ends of this long corridor will be people who would be more than happy to explain to you the floor